In this video, traders, we're going to look at mapping out all potential price moves before you take the trade. This is something that's helped me a lot, and hopefully it will help you. Stay tuned. Hey guys, warm welcome to you. All right, so if you're in a situation where you've taken a trade and the price has done something and you've kind of reacted instinctively, or you've not shown what to do, you've got a deer in headlights, or you've reacted and done something, you kind of look back on it and gone, you know what, maybe I shouldn't have done that. This may help you out, because very often as traders, we take the trade, we put our profit target in, we put our stop loss in, maybe we don't have a profit target, maybe we have some sort of idea of where it's going to go, or whatever that may be, but let's assume we have a stop and a profit target. We put that in, and ultimately we expect the price to either hit one or the other. And in our minds, we generally don't think of the whole, all different scenarios. And this is true whether you're scalping, whether you're swing trading. And actually when you're scalping, it can be a little bit more intensive because the price can do something, and because you feel like you need to do something, you're at the screen, you should be taking some kind of action, that can bring out the worst in us. But swing trading also applicable. You can be a swing trade and it's sitting there, you still don't know what to do. So one thing that's helped me out is to map out and think a little bit more about what price could do after I've got into the trade. So when I've taken the trade, rather than just thinking, oh, I'm going to get stopped out or I'm going to hit the limit, I think about all the scenarios that could occur. And guys, there are so many of them. And the reason to do this is so that in the cold light of day, when you haven't got the pressure of price changing all the time, P&L up and down, you can make an informed decision about what you expect your response to be, and then you can condition yourself to kind of follow through with that when that does happen. When you don't have a plan for it, you're kind of sitting there going, oh, what should I do for the best? Should I do this? Should I do that? And you've got the pressure of price moving, particularly if you're scalping or day trading, you've got the added pressure of time sensitivity there. You feel like you should do something. So let's have a think of kind of what you might consider where price could go. So rather than just think of target or stop, think of how will I respond if X happens. And by the way, guys, the main thing for this is to stop ourselves from responding in a negative way. Perhaps we could be a bit careful wrapping everything in a negative wrapper, if you like, but from an impulsive perspective, and then looking back and maybe regretting what we did. Whereas if we're calm and we think about different things that can happen, then we put ourselves in a much more powerful position. So first thing is a price spike. So let's say you're in a scalp. Let's go from a scalp perspective. You take a scalp, bang, price spikes right up. What are you going to do there? Are you going to take advantage of the spike and take your profit, assuming it hasn't hit your target and filled your limit? Are you going to wait for another, let's say if we're scalping, 30 seconds to see if that price spike is going to continue? Because there's a couple of scenarios there, isn't there? Let's imagine you are in a day trade or a scalp, you're there, bang, price suddenly spikes up. Do you think it's an anomaly, it's noise, I'm going to grab the profit, I'm not going to look a gift horse in the mouth? Or do you say, you know what, this could be some sort of breaking news, I'm already in the deal, why would I want to cut it? In which case, maybe the other option is to cancel your limit and see how far it goes in the next 30 seconds. Maybe the immediate thing is to drag your stop up to half of the spike. Maybe the immediate thing is to add to the position. There's multiple different things, but knowing beforehand how you're going to react means that you're not going to react impulsively. You're not going to go, oh, I'm going to see what happens, and it comes all the way back and you go, oh, I shouldn't have done that. Because even though you may plan to do something and it's not the right thing to do in terms of your P&L, i.e. maybe you said, you know what, I'm going to see what happens at 30 seconds after the spike, see if it continues and it comes back. You don't feel bad about it, and it's easier on your mindset and your discipline because you'd already said that's what you're going to do. So all you're doing is reacting as you plan to do. And so even if it happens to come back and take you out and you're like, oh, I could have taken advantage of that, you're not going to feel bad about it. Whereas if you were making a decision on the fly, you might say, well, I should have taken it, I should have done this. So there's an important distinction. Another example could be, maybe it moves close to target and just sits there. What are you going to do then? Are you going to pull the target down and just take the profits that are there? Are you going to pull your stop up? Are you going to consider that as a consolidation and maybe move your target higher? Are you going to close off half the position? Are you going to double up on the position? All these different permutations as well. So about hovers near stop, so it comes down, sits near your stop, doesn't quite ping you out. You're going to just sit with it and wait for it to ping you out. Are you going to add to the position thinking it might pop back up again, same stop? How are you going to manage that? Another thing might be, okay, well, if it stops you out and bounces straight back up, are you going to leave it, wait for another hour or so for another setup? Are you allowing yourself a re-entry? How are you going to do it? then we've got does nothing. So price just sits there and does nothing. How long are you going to give it before you close the deal? How long are you going to give it before you decide that enough's enough? Are you going to add to it because you feel like that's accepting and it's going to carry on? Are you going to scale back your position? Are you going to close your position? Are you just going to leave it? Are you going to wait? Again, we could be here all day, guys, thinking of different types of X, i.e., what could happen. The important thing is just to think of the most likely scenarios. How does price go from here to here or here to here, and how could it do that? Could it chug up? Classic one would be you've got your target in the market, drives up, comes back a little bit, sits halfway, moves up again, and you're there thinking, well, now we're maybe 2/3 of the way to my target. My stop's down here. All of a sudden, my risk order ratio has changed because I've already got a decent amount not in the bank, but unrealized P&L. So my risk order ratio is now skewed. I'm only going to make a little bit more for that much risk. Now, is that worth it because of the broader picture, or should I now be adjusting the stop and adjusting the limit? So, the whole point of this, guys, is to try to reduce the cognitive load that we have in the heat of the moment, because that brings out the chimp, that brings out the emotional decision making, and try to consider in a kind of objective manner in the cold light of day, when you haven't got the pressure of P&L and anything else on you, how you're going to react to something. And that just puts you in a much, much stronger position. It helps me loads. I always think about my trades now, particularly like, okay, what's going to happen if it gaps against me overnight? What am I going to do with that? How am I going to deal with it if it kind of has a really strong day, but my target maybe is, a good example here for me, guys, is maybe I've got a target that's quite stretched, has a really strong day and it's nearly hit the target. I might then extend that target because I'm thinking, well, you know what, it's probably going to get filled on a gap up and a drive on day 2, but I want a bit of a longer move to this. So I might now stretch the target higher, or I might drag the stop up. I might adjust the trade. Whereas if it just kind of crept up and just closed in the upper half, I'd be like, okay, fine. There's a bit more unrealized in there. I don't need to do anything with the trade. So it's also thinking, depending on the time frame you're trading as well. So consider that. If that helps, great. It might be something that helps you not react instinctively and reactively when you're in a trade, and be a little bit more calm, a little bit more considered about your trading, specifically if you're used to kind of snatching profits or doing stuff that you're trying to get better at. Anyway, guys, take care, keep your risk management. I'll see you in the next one. Bye-bye.